Welcome back to Retirement News Online. So which makes a better investment, exchange-traded funds or ETFs, or mutual funds? Well, ETFs are publicly traded collections of assets whose price changes constantly throughout a trading day. The price of mutual funds are calculated at the end of a trading day to reflect the new prices of the assets they contain. Now, there's no clear-cut answer for every investor under all circumstances, but ETFs have distinct advantages that make them better than mutual funds in several important respects. Joining us is Zach Abraham with Bulwark Capital Management in Tacoma, Washington. And Zach, thanks for joining us today. And you often say that the fees and tax disadvantages that often accompany mutual funds can make them less attractive for investors, but most people don't understand the cost. Can you talk about that?
Well, first and foremost, I think that we got to be careful not to color with a broad brush. But in general, the mutual fund, in our opinion, it's really an outdated vehicle. It's not tax efficient. This is something that a lot of advisors don't understand, and certainly most clients don't. And they understand it when they buy a mutual fund and they go through a bad bout in the market and they're down 20%, and then they get hit with capital gains. And they're, what's going on? Well, when you purchase a mutual fund, you're buying into the existing cost basis. So if that mutual fund purchased, let's say, Microsoft in 1995, and you purchased it in 2011, you're inheriting their original cost basis. So that's one issue. The other issue inside of it is just something that Vanguard and Jack Bogle have made famous, that we know that 93-94% of mutual funds underperform the benchmark or the market. And so they're charging us an excess fee, typically between, all said and done, 0.8 to 0.9% internal costs inside the mutual fund. So that's above and beyond what you're paying in advisory fees. And they're doing it, and they're underperforming the market 93% of the time. So when you look at an ETF or an exchange traded fund, think Vanguard index funds, we know that by the numbers, we're going to win 93-94% of the time, and we're also cutting out a 0.8 or 0.9% drag. The other thing that we avoid, like you mentioned, Scott, is the overlap, meaning that especially after long economic runs, this is the longest bull market in U.S. history, longest economic expansion in U.S. history, and it's really interesting. When we look at the top 6, top 10, top 15 mutual funds, and I'm talking irrespective of class, right, asset class. So we could have large cap value, large cap growth, mid cap income, mid cap value. You pop the hood on these things, and 95% of them have the exact same top 6, top 7 holdings. You could get a mid cap income fund, and its largest holding would be Facebook. I've seen this a million times. So we have this portfolio of all these different mutual funds, and when we run it through our analytical tool, we just see massive amounts of overlap. They're not diversified at all. Why does that happen? It's because the manager is chasing the benchmark. He's chasing the market. That's how he gets new assets under management. So it's not nefarious. It's just the natural way that these things happen. And so we end up with a diversified portfolio, a lot of different funds in it. But really, it's just a bunch of the same stuff stacked on top of each other, where really you could do it with one mutual fund. And then in addition to that, you've got all these internal fees that are stacked up. And then we're still not talking about the advisory fee.
And bonds are typically the choice for many investors who are looking for a strategy that is uncorrelated to equities to help diversify a portfolio. But you say that doesn't really make sense these days. Why is that?
We do not have a crystal ball. We're not always right. Nobody is. But we look at research rather than relying on anecdotal information. And when we look at the research, this whole idea that this inverse correlation, think stocks up, bonds down, right? Walk into any financial advisory office, and this is one of the first things they're going to tell you. Stocks are our offense, bonds are our defense. When stocks go down, bonds go up. Now, there's a reason why they tell you that. We got to look at the average age of most advisors, right? Most advisors that have a lot of clients and have an established business, they're late 50s, early 60s. This is their career. But when did that career start? It started in the 80s. So their entire career, all they've seen is a dropping interest rate market, which has been a wind in the sails of bond portfolios. And we've watched this inverse correlation play out. Now, when did that stop? Well, in 08-09, first year since the Great Depression during the financial crisis, where stocks and bonds both went down more than 20% in a single year. Okay, so we look at it and we go, if you have a defense of your portfolio, first and foremost, the defensive part of your portfolio, okay, first and foremost, that it's the most expensive that portfolio has ever been to have that quote unquote defense, right? Record low interest rates. We're getting paid a record low amount from that bond fund. Second of all, when did we need that defense the most? When did we need that bond portfolio to do its thing? 08-09. What happened? It got smoked right along with equities. What have we seen in the decades since then? Stocks and bonds have been moving in lockstep. 2018, S&P's down 5% with no fees, something like that. Dow was down like 6.5%. Average bond fund was down 3 to 3.5%. So they've been moving in lockstep. So that made us dig into some more research. So we did a couple research projects on this, and we looked at bonds and stocks over the last 150 years. And that inverse correlation that all these portfolios are built on, and I don't mean to sound hyperbolic, but really the theory or the concept that they're betting your retirement security on is that bonds and stocks are going to move inversely of each other. Well, over the last 150 years, that has been true 30% of the time. 70% of the time, there is no correlation. That stocks can go sideways, bonds can go down, bonds can go up, stocks can go up. They can both move down together. So we're basing this entire portfolio structure. We're betting clients' retirement financial, lives on this concept that just isn't true. And moreover, what's really frustrating is we're not predicting that correlation is going to break. It's broken. It's been broken for the last 10 years, and yet we're still doing things the same way. So we're just trying to shed some light on that and sound the alarm and say, look, if you're hoping that this works out or you're betting on this working out, it hasn't. And more importantly, it not working isn't the anomaly, it's the average.
That's Zach Abraham in Tacoma, Washington, and this is Retirement News Online.